I have already told you the power of paying down your mortgage faster by making additional repayments. But what if I told you that there is another way that is faster and you're not really paying down anymore? Just before I begin, welcome to my channel. My name is Mihir and I upload educational content such as this twice a week. So if you're interested, please hit like and hit subscribe. Without a further ado, let's get straight into the content. The thing I'm talking about, drum roll, is an offset account, specifically a 100% offset account. But wait, just because you know what a 100% offset account is, please don't click off this video, because I'll show you the power of this combined with other things that you can do with structuring your loan. So please just stay put, and I promise it'll be worth your time. But for someone who is sort of new to this and doesn't understand what a 100% offset account is, let me explain what it is. To put it simply, the total balance on your offset account offsets your designated mortgage, thus reducing interest payments on the period of the loan. Let's say in this example, you have a home worth $500,000 and your designated mortgage is $300,000. In this context, it doesn't matter if you have a standard, variable, interest only, or principal interest loan, but let's just say the interest rate is 5%. So 5% of $300,000 is $15,000 per year on interest. Now let's say, for the sake of this example, you parked $100,000 in that offset account for at least 12 months. What would happen is that it would reduce your designated mortgage from $300,000 to $200,000. And if you're paying 5% on $200,000, you'd be paying $10,000 worth of interest every year. So first you're paying $15,000 per interest every year, and now you're paying $10,000 as you've reduced the designated mortgage amount. In this simple example, you can see that you've saved yourself $5,000 per year, which was going to be paid in interest. And now this brings me to a key distinction that needs to be made. Interest saved is better than interest earned on bad debts. So bad debts include non-tax deductible things such as home loans. The reason why I say interest saved is better than interest earned is because, let's say, for example, rather than parking $100,000 in your offset account, you do it in a term deposit or your savings account and you get a 5% return. 5% of $100,000 equates to $5,000, which you may have made to maybe interest. But the thing with that is that it's subject to your marginal tax rate. So in the instance of the offset account, you saved $5,000 worth of interest, which you would have had to pay with your job, which is after tax money. So that's what I'm trying to get at here. But now you may be saying, well, Mihir, how is this possible? How can anyone truly have just $100,000 lying around, especially middle-class Australians? The key thing here is that you must use a plausible amount left after expenses and keep putting that towards your offset account. But don't worry, I've already got a good example ahead in this video which covers the sort of average or median sort of Australian in terms of income and what they can do. So just hold on a sec. But before I move on, the next important distinction is that how is interest calculated by the banks and on your loan? Interest is calculated daily on a principal outstanding balance and charged monthly in arrears. I'll now put up an example somewhere on the screen where you can see how it's calculated. You can see that there's a simple closing balance of the loan at the end of the day times the interest rate divided by 365 days, so days in a year. And let's say we go with our example of $100,000 times 5% over 365 days. You can see that that includes, or comes out to be, $13.70 daily interest charge. Now, I want you to keep in mind that the number of days varies month to month. Now I'll be putting up a table where you can see the interest calculated daily on a monthly basis. Now I'll talk about the impact of putting $10,000 in a 100% offset account for a loan term of $100,000. You can see here in this diagram, hopefully, that at the end of this, you save around $500 of interest per year. But more importantly, you reduce the term of the loan. Now you may be thinking, well, Mihir, how's $500 worth of interest saving per year will truly help me pay down my house faster? Well, just hold on a second. In order to truly illustrate the effectiveness or power of offset accounts, you got to merge it with interest-only loans. But I won't be doing this in this video, and I don't want you to think that that's like the only way to truly pay down your house faster, as even with the principal and interest only loan, which majority of Australians take due to being able to borrow more, you can still significantly reduce your mortgage period, and I'll show you an example in just a sec. But first, we've got to identify or just make a profile of what the average Australian is. In my example, I've chosen two couples who are both earning $60,000 per annum, and they're pay-as-you-go sort of employees. And let's see what happens if they park their fortnightly salaries into a 100% offset account. First things first, let's deduct tax. An average individual earning $60,000 per annum as a pay-as-you-go employee will pay $11,847 worth in tax, thereby leaving a takeaway home or net profit of $48,000 per annum. And if you did that monthly wise, you'd get $4,012 after tax. To keep this simple, let's multiply the couple's after tax monthly income by 2. So that's $4,012 times 2, which equates to $8,025. Now let's keep this simple. A $500,000 loan with a loan period of 25 years and an interest rate of 5% would equate to interest-only payments monthly of $2,083, whilst principal and interest-only monthly payments of $2,922. Let's say that this couple parked their salary into that 100% offset account and have been using an interest-free credit card which lasts for 44 days to pay their daily living expenses, bills, and things such as that. And on the 44th day, the credit card will be paid off from the money in the offset account. Now let's take a look and dive into the couple's financial scenario. You can see that they're earning a net amount of $8,025 per month. Their monthly mortgage is $2,992. Their total monthly living expenses are $3,000. And lastly, their monthly savings are $2,102. The key thing you guys got to understand is that the following assumption of the diagrams we're about to present only work if the couple are putting the monthly savings into that offset account, and they keep doing that over and over and over again. I'll now put up the numbers. So based on the graph, you can see that the couple have shaved off a massive difference. That they've shaved off more than half the time. I'll also put up a table that summarizes everything in just a sec. In this table, you can see that they have shaved off 14 years off their mortgage. Imagine that, 14 years. Not to mention, they have saved $229,000 worth of interest. If this isn't insane, I don't know what to say, ladies and gentlemen. Imagine if the couple chose an interest-only loan. How phenomenal would that be? But besides that, and besides getting a primary place of residence, what about investment properties? Imagine the impact if you got the monthly rental and you put it into an offset account and you just don't touch that money. So imagine how fast you'd be able to pay your investment properties off. Because it's scary and crazy to think that Australians work majority of their life just to get an asset, so they put in 25 and 30 years. And yes, they do have an asset, but they don't have any cash flow. They end up like dead broke. Because sure, you got the house, but where's the money going to come from? Just before I end this video, I want to ask you a question. How long do you think it would take for a young Australian couple with a combined income of $120,000 to earn $229,755 after tax? A lifetime. If you like the information I presented to you and you're more interested in things such as this, I highly encourage you to pick up and read Australian Property Finance Made Simple by Conrad Bobilac, because I'm sure you may have read of the books such as Rich Dad Poor Dad and other sort of investing books, but they really don't cover too much about Australia. They're more catered toward the American audiences, or they're more mindset and not practical. This book is really practical and it's focused on Australian society. So I suggest you check that out. But besides that, if you enjoyed this video, please hit like and hit subscribe, because that will truly help me out with this. But besides that, I hope you have a fabulous day ahead of you, and goodbye.